Hi, I'm TaxMax. Let's break down today's tax topic.
Quick tax fact before we start. The profit a company shows in its accounts is almost never the profit it pays tax on. In earlier episodes, we explained what corporation tax is, how it's calculated, and how company tax returns work. This episode focuses on a key step in that calculation, adjusting trading profits. This is part 1 of a short series. Here, we'll cover the core rules behind adjustments and the most common costs that are not allowed for tax. Later parts will cover allowable costs, mixed expenses, capital items, and a full AZ reference. Companies prepare accounts using accounting standards. Corporation tax, however, is based on tax law, not accounting rules. Because these systems have different purposes, the profit shown in the accounts must often be adjusted before tax is calculated. Those adjustments move us from accounting profit to taxable trading profit. Most adjustments come back to 4 simple ideas. Purpose. A cost must relate to running the trade. If it has a personal or non-trade purpose, it may be blocked. Second, capital versus revenue. Day-to-day running costs are usually revenue. Spending on long-term assets or lasting improvements is usually capital and not deducted from trading profits. Third, specific legal blocks. Some costs are disallowed by law, even if they feel business-related. Fourth, timing. Tax relief does not always follow accounting timing. Some costs are allowed only when paid or under separate regimes. Understanding these 4 rules explains the majority of adjustments. If a payment is a penalty or fine for breaking the law, it is not deductible for tax. This applies even if the issue arose while running the business. The reasoning is simple. Tax law does not reduce the cost of non-compliance. Entertaining customers or other third parties is generally not deductible. This includes meals, hospitality, and related extras. Political donations and payments to political organizations are also generally not deductible. These rules exist regardless of how commercially sensible the spending might feel. Corporation tax itself is a tax on profits, so it is never deducted in calculating those profits. Similarly, costs that are really capital in nature cannot be deducted as trading expenses, even if they appear in the accounts. If a cost creates, improves, or significantly enhances a lasting asset, it is usually removed from trading profits and dealt with elsewhere in the tax system. These disallowances are some of the most common reasons accounting profit and taxable profit differ. They are also areas where mistakes are easy to make because the accounts alone don't tell the full tax story. In part 2, we'll look at the other side of the picture. Common allowable costs, mixed business and personal expenses, capital allowances and timing differences. And in part 3, we'll pull everything together with a clear AZ reference. And that links back to the fact we opened with at the very start. The profit shown in a company's accounts is rarely the same as the profit it pays tax on, because tax law applies its own rules to those numbers. That is exactly why adjustments exist, to move from accounting profit to taxable trading profit using specific legal principles. I told my accountant a joke about depreciation. It lost value over time.
Educational content only, not advice. Rules can change.